Yeah, I've got gold going to $10,000, which at this point it's going to hit $10,000 a lot faster than people think. And there's some interesting reasons for that. We can go into the fundamentals and explain why gold's going up. I'm happy to talk about that. But in terms of that price target and getting there, probably in 2026 and maybe not even that far into the year, there's a behavioral psychological phenomenon called anchoring. And the idea is you get an idea in your head, it could be a number or a theme or whatever, and you anchor on it, and then you begin to filter all the data you're getting through that anchor, and it can change, but that's a very, very common phenomenon. So people will look at gold, and they'll have a number, let's just say $1,000 an ounce. So it goes from, $2,000 an ounce to $3,000 an ounce. Now it's made its way to $4,000 an ounce. And that took a while, it took a couple of years. Percentage-wise, these are good gains, but that took a couple of years. So they go, oh wow, $10,000. It seems like the dark side of the moon. It's going to take forever to get there. But the math is that so if you have 50 ounces and it goes up $1,000 an ounce, you made $50,000. Okay, it goes up another $1,000 an ounce, you made another $50,000. So you're anchored on the $1,000 steps and the $50,000 you made, which is all true, and that doesn't change. But when you go from 2,000 to 3,000, that's a 50% gain. When you go from 3 to 4, that's only a 33% gain. Well, when you go from 9 to 10, that's only an 11% gain. That's like a good month the way gold's been trading lately. So the point is, people kind of lose sight of that. So yeah, 3 to 4 made it, 4 to 5 getting there, but you're going to go 7, 8, 9, 10 really quickly because those are smaller percentage gains.
Yeah.
And that's something that people, they extrapolate 2 to 3, how long is it going to take to get there? The answer is probably not very long. We're not at the frenzy stage yet, which is important because retail's not all in. I was just down in Australia not long ago with friends from ABC Bullion. They have an office in the central CBD, central business district, and a friend of mine sent me a picture the other day. They were queued up around the block waiting to get in to buy physical gold, but that's recent.
Very recent.
Yeah, well, that's right.
It doesn't happen around here.
It does not happen in the United States. The U.S. will probably be the last to get there. It's happening in China because they don't have too much else to invest in, and it's sort of caught on in Australia. Bearing in mind, you got to take in their currency is going down against the dollar, so gold's going up even more in terms of their currency. So these are kind of at least mild psychological effects that go beyond the fundamentals. And again, we can talk about the fundamentals. But it's if you take 1971 to 1980, so gold went up 2,300%. But another way of thinking about it is that gold didn't do anything. It's gold, atomic number 79, it's an element. As you put it in a drawer, come back a year later, open up the same amount of gold. So what's really happening when gold does something like that? Well, what's happening is the dollar is collapsing. So if you measure by weight of gold, and that's it's not arbitrary, but it's just a metric, measured by weight of gold, the dollar declined 95%, approximately 95%. So there's your dollar crash. Everyone's like, when's the dollar going to crash? Well, it did, measured by weight of gold. So that's starting to happen again. That gets into a much bigger narrative. When you say what's going on with gold, there's a narrative. Wall Street loves narratives. Some of them are completely just wrong. They're kind of made up because Wall Street always needs a story to sell you stuff. Some of them are they're self-fulfilling. Like they start out not true, but they become true because people buy into them. And then some of them are right. So you can't just say narrative. You gotta, Robert Shiller wrote a good book on this, but you got to figure that out. But the narrative. Let's start with the narrative, which I think is almost completely wrong. So the narrative is. The U.S. is $37 trillion in debt. Actually, it's just got to 38 the other day. So I have
the debasement trade.
The debasement trade is exactly. So yeah, $38 trillion of debt. The highest. It's too much. We can never pay it off. Well, first of all, quick aside: we haven't paid off the national debt since Andrew Jackson. 1836 was the last time the United States was debt-free. So you're never going to pay it off, and you don't have to. They have 38 trillion, bang the table, boom, boom, boom. China's dumping treasuries, everyone's dumping treasuries, bond vigilantes have saddled up, interest rates are going up, interest rate on the debt alone is greater than the defense budget, U.S. is going bankrupt, et cetera, buy gold. Everything I just said is false. I mean, it is the narrative, but let's just kind of put that in context. Number one, the debt is $38 trillion. That's looking at the liability side of the balance sheet. You got to look at the asset side. 150, 200 trillion, don't know. Are we going to sell Yosemite? No. We're going to sell the Grand Canyon? No. But there's an awful lot of mining rights, mineral rights, oil, natural gas, Gulf of America, intellectual property, none of which the U.S. has monetized very effectively, a lot of which we actually squashed. So I'll give Scott Bessent credit for that. He's trying to monetize the asset side of the balance sheet. So that's one thing. Number two, you don't have to pay off the national debt. In fact, we're not going to. You don't even have to pay it down. So the key metric, and the only one that really matters, is the debt to GDP ratio. What is the government debt to GDP? And one way to think about that is, let's say you owe $50,000 on a MasterCard. Is that a lot or not? Well, you can't answer that question without knowing how much money you make. If you make $20,000 a year and your interest rate is 28%, you're probably going broke. If you make $500,000 a year, you write a check and it's done. So you have to put the debt in the context of the income. That's why the debt to GDP ratio is powerful. Now, right now it's about 123%. 37 trillion of debt, GDP's 30-ish, 29, 30. So it's 123%, which is the highest in history, and that's not a good thing. I'm not sloughing it off or saying we should ignore it. It's not a good thing at all. Highest in U.S. history. But at the end of World War II, it was 114%, which was the highest at the time. Of course, we won the war with our allies, so that was good. By 1980, at the end of the Carter administration, when Reagan came in, that number was 32%. So how did we get from 114% to 32% in terms of the ratio, which 32 is very comfortable, by the way. It's like practically having no debt. One thing we did it. It took 35 years, from 1945 to 1980. One thing that impresses me about that accomplishment, it was completely bipartisan. You had Democrats like Harry Truman, JFK, LBJ, and Jimmy Carter. You had Republicans like Dwight Eisenhower, Richard Nixon, Gerald Ford. But it was not, they politicized everything else. They could argue about lots of stuff. They did not argue about that. They said, we gotta get this down. Now, here's the bottom line. The national debt in 1980 was 3 times what it was in 1945. The deficit, annual deficit in 1980 was 3 times what it was in 1945. So the deficit tripled, the debt tripled. Well, how the heck did we get the ratio from 114 to 30? The answer is growth.
Yep.
Growth was 10 times, and that's the key. So this is what Scott Bessent is working on. He calls it the 3 arrows, which is fine, not the Japanese 3 arrows. But he says if you keep deficits at 3% of GDP or less and get real growth at 3% of GDP or more, notice I said real because when you do debt analysis, you have to use nominal debt. So with 2% inflation, which is low, but 2% inflation, your nominal growth is 5, and then he wants 3 million additional barrels per day of oil production, which will help keep gasoline prices down. But just take the first 2. If the debt's growing at 3% a year, and the economy's growing at 5% nominal, 3 plus 2, then the ratio is going down, and that's all the market has to see. And if you did that for 1 year, your debt to GDP would go from 123 to 121. Everyone's like, hey, 121 is still pretty high. Yes, but it's moving in the right direction. We're sort of replaying what we did after 1945. Now, so the math is simple. The math is simple. The plan is straightforward. Whether you can pull it off or not is a different question. That's a policy question, and that's what I'm watching.